Hello and welcome to the Business Standard Morning Show. I'm Minu Sandhu. Let's take a look at the stories for the day. India's realty sector staged a stunning comeback last year after going through its worst phase in 2020. Riding high on renewed buyer confidence and low home loan rates, it was expecting to grow further this year. But the third coronavirus wave, led by the Omicron variant, is threatening to cast a shadow over home sales once again. This report takes a look at whether the resurgence of COVID-19 will impact the property market.
India's biggest property market, Mumbai, saw a record 1.1 lakh property registrations in 2021, surpassing the previous record set in 2018. This was the first time that annual registrations crossed the 1 lakh mark in India's financial capital. The milestone came even as the benefit of lower stamp duty was rolled back in April. Data from Anarock Property Consultants showed a clear picture of the sector's recovery. Housing sales across the top 7 cities rose 71% in 2021 to 236,530 units, indicating a strong consumer sentiment. The demand, however, still fell short of pre-COVID levels by 10%. Anarock has attributed the rise in housing sales to very low interest rates on home loans, pent-up demand, surge in aspiration for home ownership, cut in stamp duty by a few states, including Maharashtra, and discounts offered by builders. Led by the festive demand, the October to December quarter contributed nearly 39% to overall sales during the last year. But now, with the rise in Omicron cases, several states have imposed restrictions. Can this break the strong sales momentum that is continuing from last year? Anarock's Prashant Thakur is not anticipating a major disruption in the real estate sector because of a third wave. He explains why.
So the calendar year 2021 saw a very robust recovery in the residential real estate after a devastating 2020, where the sales and launches almost came to a standstill because of the first wave that we saw. And again we are seeing the talks of third wave and Omicron again resurfacing, and now everybody has a question that will it impact the growth cycle that this residential is seeing. So in my opinion, see, while the threat is there of this virus spreading, I feel the developers are better prepared this time, and then compared to the first wave that we saw, the digital adoption that this sector has done is phenomenal. And if you look at the vaccination rate also in India, it's quite impressive. And the supply chain disruption that we saw during the first wave is also more or less sorted out. So in my opinion, while there will be some pockets of disturbance, I don't think this is going to have a major impact on the overall recovery that we are seeing.
And what are the prospects for commercial real estate and office space in particular? Thakur answers.
We are still seeing the digital launch of various projects happening. There's this kind of a robust launch pipeline that the developers have for this year. And I think all the buyers would like to cash in the low interest rate regime that is still prevailing, because we all know that with the inflationary pressure rising up, sooner or later the interest rates will start to move up. So in my opinion, that will also play on the minds of the buyers. And I think developers also are taking good care of avoiding any supply disruption. For example, they are taking good care of the labor on site. The compliance of all the COVID protocol is quite high. And in this background, I feel that the recovery is going to gain certain amount of momentum. Yes, we need to keep a guard up against this virus. But again, having said that, I don't see a major disruption happening in this sector right now.
Property prices may go up 5 to 10% in the short term, as developers may not be able to absorb further escalation in the prices of raw materials like steel and cement. Ratings agency CRISIL expects residential real estate to see a moderation in growth rate to 5 to 10% in FY23 in the top 6 cities, due to a high base and as interest rates start inching up. CRISIL expects the sales to rise 30 to 35% this fiscal, surpassing pre-COVID levels amid a strong consumer pull from favorable affordability and moderated capital values. A wave of new launches, led by Mumbai, Pune and Hyderabad, are lined up for this year. Many organized and smaller players have formed joint ventures and joint development agreements to take advantage of the new wave. Therefore, any disruption due to Omicron is likely to be a blip in the ongoing demand recovery.
After the property market, let us now see what is happening in the nascent cryptocurrency market. Just as the new year rolled in, Indian crypto exchanges woke up to a rude call. The Directorate General of GST Intelligence has launched a probe over alleged GST evasion against various crypto exchanges. This comes after the Central Goods and Services Tax Mumbai zone detected GST evasion of Rs 40.5 crore by one exchange. Now, will these incidents nudge the government to take some bold measures and put a regulatory framework in place for cryptocurrencies? Our next report finds out more.
The new year hasn't brought with it any regulatory clarity on cryptocurrencies, and this has its consequences. Last week, the Central Goods and Services Tax Mumbai zone said it had detected GST evasion of Rs 40.5 crores on commission earned by Indian crypto exchange WazirX. The Mumbai-based crypto firm had to cough up Rs 49.2 crores, which included its GST dues plus interest. The contention was that WazirX wasn't paying GST on the commissions that it charged on transactions through its platform. If the transaction is in Indian rupees or cryptocurrencies such as Bitcoin and Ether, WazirX charges a commission of 0.2%. But if the transaction is in WazirX's own native utility cryptocurrency called WazirX token or WRX, the exchange charges a commission of 0.1%. The tax authorities have claimed that WazirX was only paying GST on the commission it earned in INR transactions, but not on the commission it earned in its own cryptocurrency WRX. The argument seems to be that by facilitating peer-to-peer transactions on its platform, WazirX is providing a service which is taxable at 18% GST. This is similar to what commodity exchanges and other intermediaries have to pay in India. After GST recovery from WazirX, the Directorate General of GST Intelligence under the Ministry of Finance has reportedly launched probes into the commission structure of various other crypto exchanges, investigating whether there are more cases of GST evasion. Crypto exchanges, on their part, have claimed that the issue arose because of a lack of regulatory clarity on the treatment of cryptocurrency as a currency, a commodity, a service, or something else. We spoke to Shashi Matthews, partner for direct tax at Indus Law, to understand more about this issue.
Under GST, the tax is paid on supply of goods or on supply of services, and that does not extend to transactions in money or securities. Money is defined under the GST as legal tender which is recognized by RBI. A similar definition also extends to securities as to those which are recognized by the Securities Contract Regulation Act. Cryptocurrency does not fall in either of two, quite evidently. Now, the question that comes out is whether it's a supply of goods or supply of services. And we are hoping that the cryptocurrency bill will address that to some extent. But until then, there is really a gap in the law, because some may see cryptocurrency as a supply of service, some may see cryptocurrency as a supply of goods. Essentially, they are an asset class, and that's what the industry also has been saying. Insofar as transaction fees, commissions, or brokerages being charged by cryptocurrency exchanges on transacting on these exchanges, those will attract GST as a supply of service. And I think that that is clearly the picture that's emerging out of these searches being conducted by the GST authorities. And we'll have to await for further clarifications from the CBIC or the government on what exactly are these items being classified as.
If the WazirX incident serves as a precedent, then at least part of what crypto exchanges provide can be categorized as services and taxed accordingly. This could provide some clarity to Indian crypto exchanges going forward. Indian crypto firms also await clarity on how to treat the income made through crypto investments. While there is no clarification from the government on that front either, industry players have built a consensus. Users are advised that if they've made a small profit and cashed in before 36 months, then such gains from cryptocurrencies will have to be listed under other income in the tax form and be paid as per the tax bracket applicable to them. If cryptos are held for more than 36 months, then gains should be classified as long-term capital gains and will be subject to tax at 20% plus applicable surcharge and cess. Indian crypto exchanges are also routinely probed for violating the Foreign Exchange Management Act, which permits cross-border barter only through authorized banking channels. In this context, cross-border crypto transactions being facilitated by Indian crypto firms are seen running afoul of India's FEMA rules. More clarity is expected along these lines every year during the budget session. It remains to be seen if India's long-awaited bill to regulate cryptocurrencies will see the light of day next month.
The cryptocurrency market was trading in the red yesterday, just like FMCG player Marico. Its shares dropped 3% after the company announced a tepid Q3 update. The company said that high inflation and moderation in rural demand led to a muted volume growth. And this was restricted not just to Marico, but could be a sector-wide phenomenon. So does this mean other FMCG players are also staring at a stock price correction? Should investors turn away from these players? Here's what D Street experts have to say.
Inflationary pressures are biting into FMCG players' volume growth. Moreover, plateauing rural demand due to falling disposable seems to have hit consumption-based companies. In its Q3 business update, Marico stated that the December quarter of FY22 was characterized by slowing consumption patterns, which affected the sector as a whole. This was mainly due to continuing inflation impacting overall disposable incomes as well as rising mobility, unleashing some degree of pent-up demand for discretionary goods, services, and out-of-home consumption. According to the company, its revenue growth in the quarter was in double digits, while volumes were flat owing to the weaker consumption sentiment and a strong base. With muted volume growth across segments, the company expects overall consolidated revenue to be in low teens with lower margins on a yearly basis. The numbers cast a spell not just on Marico but highlight the turmoil faced by the entire sector. According to a Business Standard report, rural demand for fast-moving consumer goods was weak in the October-December quarter on a year-on-year basis, with sales likely down by 8 to 10%. And the trend, analysts say, may continue to haunt players for a while. For one, the current inflationary pressure is due to supply-side constraints and appears to be more stubborn than usual. Besides, resurgence of fresh virus variants and ensuing restrictions are acting as one of the stumbling blocks in normalization of supply-side issues. Considering this, analysts at Centrum Broking are equal weight on consumer goods companies. ICICI Securities, meanwhile, is neutral on the sector as companies face margin headwinds. In a sector report, the brokerage highlighted that we reckon most companies are getting distracted from their core agenda of penetration-driven growth as they worry about disruption in all facets of operations. So, given the headwinds, are FMCG investors in for a wild ride? According to analyst at Prabhudas Leeladhar, input cost scenario remains volatile for FMCG players, but margin weakness may bottom out in Q3. Besides, over 20% correction from recent highs makes select players attractive from a long-term perspective. Let's go to Suvarna Joshi, Senior Research Analyst at Axis Securities, to know more.
To ward off the inflationary pressures on profitability, companies have taken price increases in Q3 and also from the start of the calendar year 2022. And to that extent, there will be some safeguarding of margins that will be seen on a sequential basis. We do think that for H2 of FY22, it will be a story of volume, it will be a story of value realization growth as against volume growth, which drove earnings in H1 of FY22. We think that volumes could be in low to mid single digits for Q3 of FY22, which is with the start of the earnings season that we will see. Digital is another trend which continues to be strong, and thus, in spite of inflationary pressures, the niche digital-oriented products, particularly in the beauty and personal care space or the D2C space, could see healthy demand traction. In volatile times as currently we are seeing, it is prudent for traders to hold on to their guards, while for investors, it would be good to befriend volatility and seek corrections as opportunities to build long-term portfolio. This is because we see huge growth opportunity for the FMCG space, which is expected to grow at a CAGR of 14% over the coming 5 years. Particularly to play the earnings season, we do think stocks like HUL, Dabur, ITC and Godrej Consumer Products could provide opportunities for decent returns of 5 to 7%.
Vineet Bolinjkar, Head of Research at Ventura Securities, meanwhile, believes the government's push towards capex building will support rural income over the medium term, supporting overall demand in the space.
So, one thing is very clear, that the crude oil and the edible oil prices, which had gone up through the roof, had impacted rural demand very significantly. Now, all these things are wearing off, and prices are expected to settle at much more lower levels. We expect another 20% kind of decline in the prices of palm oil. And so we believe that the discretionary spend should start improving. Direct beneficiaries are going to be the FMCG and consumption-driven stocks. Further, we have the Kharif crop, which was very good, and we are expecting to have a very good Rabi crop also. And with the government spending very, very aggressively on infrastructure, rural incomes are going to remain elevated. So the best way to play this segment would be to buy the dip.
Overall, the near-term trajectory remains choppy for FMCG players amid growth concerns. However, medium to long-term outlook remains strong on expectations of a pickup in rural income and easing commodity prices. As regards today's services PMI data, stock-specific news flow, developments around the Omicron COVID-19 variant, FII activity, and global sentiment will guide the market trajectory.
With markets touching a new high, the interest rates on home loans have hit a record low in India. Although not directly related, they are the indicators of a healthy economy. The country's largest housing finance company, HDFC, has slashed its home loan rate to 6.7%, while several public sector banks are now offering them at 6.5% or below. But is it the only factor to consider while taking a home loan? We explain.
The Reserve Bank of India kept the key policy rates unchanged last month. It helped the banks to keep the interest rates on home loans low. Some lenders even went on to slash it further to support the ongoing recovery. Housing Development Finance Corporation, or HDFC, India's largest housing finance company, is offering home loans at interest rates starting at 6.7% to new applicants, regardless of the loan amount or employment category. It has joined the State Bank of India and Kotak Mahindra Bank in bringing down the home loan rates in the recent months. Kotak Mahindra Bank is offering a rate of 6.55% per annum for a limited period, while SBI is offering home loans starting at 6.7%. Home loan interest rates slipped below 7% last year. A big factor that decides the interest rate is the credit score of the borrower. For example, HDFC is offering its special rate to those who have a credit score of 750 and above. Other factors include the homebuyer's age and income. HDFC Managing Director Renu Sood Karnad has said that record low interest rates, government subsidies and tax benefits have helped homebuyers. The interest rates have fallen on the back of RBI's liquidity infusion measures to support growth and credit uptake after the pandemic battered the economy. For now, home loan rates seem to have bottomed out. However, customers need to keep a few more things in mind before they decide to buy a house in the current scenario. In most home loans, the interest rate is linked to an external benchmark, generally the RBI's repo rate. Therefore, customers will not be able to lock in at the current rock bottom rates. The EMIs will rise as the repo rate is hiked. The repo rate was kept unchanged at a record low of 4% in the last monetary policy announcement. One can also opt for fixed interest rate to insulate their cash flows from market fluctuations, but the interest rates are a tad higher in it as compared to floating rates. Experts believe that the central bank may hike interest rates in the first half of 2022. RBI is also expected to slowly roll back its accommodative policies that have facilitated easy liquidity conditions. All of this may lead to a hike in the interest rates. Homebuyers should also consider the cost of down payment, stamp duty, registration fee and property tax. In Noida, a stamp duty of 7% is levied on the total cost of the apartment one purchases, and the registration charge is 1%. These rates are different in every state. Of course, buyers can claim a deduction of up to Rs 1.5 lakh for principal repayment under Section 80C of the Income Tax Act. In addition to this, a deduction of up to Rs 2 lakh can be availed of on the interest payment under Section 24B. Borrowers should also look at loan-related charges like the processing fee, administrative fee, prepayment charges, conversion charges, legal fees and inspection fees before making the big move. Buyers should try to limit their EMI to 25% of their monthly earnings. And experts say they should invest in ready-to-move projects as it will save them rent, and it will also protect their interest as several projects continue to be delayed by several years.
Home loan not just helps you build an appreciating asset, but it is also a good tax saving tool. So it's a good idea to do thorough research before making the big move. That is all for today. We'll be back tomorrow morning with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.